Hi, I'm Jimmy. In this video, we're going to look at dividends, specifically why a company might cut their dividend and ultimately how we can determine if that cut in dividends is a bad thing for investors. And then hopefully we can use this information to help improve our investment portfolio and make better investment decisions. Okay, so let's jump right in. So there are a few different reasons why a company might cut their dividend. One reason a company might cut their dividend is because they need the cash to help fuel additional growth, or perhaps they're looking to make a big acquisition or something along those lines. And in this case, a dividend cut would probably be a good thing. In theory, if a company is paying a dividend, that's likely because they haven't found great uses for the cash that they have. So returning that cash to shareholders could make a lot more sense than just sitting on it. And if the company then finds a great way to grow the business, well, they suspend their dividend or they reduce their dividend to help save some additional cash. A good example of this is the pharmaceutical company Pfizer. So back at the tail end of the financial crisis, Pfizer announced that they were going to acquire another pharmaceutical company called Wyeth. Now, this was a big acquisition back then. It was going to cost Pfizer about $68 billion to buy Wyeth. So one of the things that Pfizer elected to do was they cut their dividend in half, from 32 cents a quarter to just 16 cents a quarter. Now, this chart shows the annual dividend for Pfizer going back to 2003. And as we can see, they cut their dividend in 2009. And although it looks like they dropped it again in 2010, they really didn't do that. What happened there is that they cut their dividend about midway through 2019. It was actually one quarter in, not 2019, 2009. One quarter in 2009, they paid 32 cents. And then 3 quarters, they paid 16 cents. And then in 2010, they actually increased their dividend to 18 cents per quarter. But 4 quarters at 18 cents was still less than what they had paid out in 2009. Either way, the key to this whole thing, that the fact that this dividend cut was a good thing, was that it was done to help fuel growth. And if we were curious about the performance of Pfizer from the day that they announced that they were going to cut their dividend, well, from there, within a month, they were up about 14%. Within a year, they were up more than 32%. And within 5 years, they were up more than 180%. So clearly, this didn't hurt Pfizer too much. But let's face it, most companies that cut their dividend do so because they either are in financial trouble, or perhaps they ran into some unexpected expenses, or perhaps an unexpected dip in revenue, sort of like what's been going on recently with the coronavirus. Either way, oftentimes a reduction in the dividend is done for a negative reason. And we've actually seen quite a few of these examples recently. One good example of this is Disney. So in my last video, I actually did an analysis of Disney's stock, and I meant to talk about their dividend, but somehow I forgot to talk about it when I actually shot the video. So let's take a second now and look at what's happened with Disney's dividend and what it could mean for Disney's stock. So this is a chart of Disney's dividends that they've paid out over the past few years. Now, typically, we can see that they've paid out their dividends on a semi-annual basis. That's when they pay their dividend twice a year. And usually for Disney, their dividends have an ex-date in July and December of each year. The ex-date is the date that we need to own the stock by if we want to receive that dividend. Okay, then we can see that in the recent July 2020 time period, Disney skipped that dividend. And they actually issued a press release talking about it. And there they said that they were skipping the dividend given the significant operational and financial disruption caused by COVID-19. Okay, now we know why they cut their dividend. But is this a bad thing for Disney's stock? And I actually think the smartest way for us to look at this is to separate in our own minds Disney's stock and Disney's business. For Disney's stock, well, yes, clearly skipping a dividend, maybe more than one dividend, depending on how things shake out over the rest of the year, well, clearly this is a bad thing for investors. We as investors generally love dividends, so we want them to pay them. And the fact that they can't pay a dividend given the operational and financial disruption, well, that's not a good sign for us investors. But what about the other side of this? What if we were looking at this as if we were running the company? And our job when we're running the company is to do what's best for the long-term growth of the company. And when we, as management of Disney, run into a worldwide pandemic that forces a large piece of the population globally to close down, including some of our major financial cash generating operations, the parks, things like that. Well, now does it make sense to skip a dividend payment? And I'm sure we're all thinking the same thing. Of course it makes sense to skip a dividend, maybe more if we need to. And if we think about it, this is actually the best thing. This is the best long-term move for both the company and for investors. Personally, I'm actually not a fan of companies that cater to the whims of investors. If things are done to please investors, that's when I think that a company could go astray. That's when greedy, profit-hungry decisions begin to get made. And oftentimes, that's the beginning of the end of the high-quality company that, in theory, we originally thought we were investing in. This is one of the reasons that I like Disney. It's one of the reasons that I personally own shares of Disney, because they appear to care about the quality of the product that they're putting out. They seem to care about putting out a high-quality product or high-quality experience. And I believe that if a company focuses on the quality of the company first and then care about what investors does, well, in the long run, investors should do quite well. That's why during something like the coronavirus pandemic, it makes no sense to cash strap the company when they could just keep that cash, make the changes that they have to better adapt for the future. And in doing that, the company ends up with a stronger operational position going forward. So the question as to a dividend cut being a good thing or a bad thing really comes down to why the company is doing it and what is the long-term outlook for that company. In Disney's case, I think it's a smart move, like I said, because conserving the cash now, in theory, prepares them better for the future. And since I hope, at least, that the coronavirus is a temporary setback, even if it lasts a year or two, well, Disney should come back just as strong when it's over. Now, on the flip side, if we were to consider a company like Blockbuster, and for those who don't remember, Blockbuster was a company that allowed people to go to the store and rent movies and video games. But then Netflix came out, and in the early days, Netflix they mailed you the DVDs. And Blockbuster's business began to take a nosedive. And I believe it was August of 2005 when Blockbuster announced that they would not pay the typical dividend that they'd been paying in previous years. And by that point in time, they were consistently losing money, and within a few years, they had filed for bankruptcy. So in that case, when they stopped paying their dividend, it was because their business was fundamentally broken. So if we were investors in Blockbuster back then and we see a dividend cut, well, now it makes sense for us to reconsider what is the long-term prospects of this business and then adjust accordingly. In that case, it would make sense to sell the stock. Now, I know that there have been a decent amount of companies that have lowered or even stopped their dividend in the wake of the coronavirus. And many times, when a cut in the dividend is first announced, the stock initially drops as some more short-sighted investors jump out. But if we focus on the long-term sustainability of the business, and if this is what ultimately guides us, then this will go a long way towards us being able to better understand if the stock is worth buying or holding or selling when a dividend cut happens. Now, if we're looking for a good way to better understand when to sell a stock, I actually did a video where I go through how to determine if it's a good time to sell a stock. And if you're curious, perhaps that could be a good next video for you to watch. I have a link right here, and I have a link in the description below. And I want to thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.